Hi folks, my name is Tom Amini Karazi from Rancho Cucamonga, California, and today I'm going to spend some time with you and share some concepts to help you build your business and the investment, and also really give you guys a confident voice across the kitchen table. You know, one thing that's very important we have to understand is this business is about teaching our clients the proper financial behaviors and habits so they can get across the finish line to financial independence. And I'm going to be very candid with you and get your notepad out, because it's important that you take notes on this. And personally, before I even get started, the disclosure I got to give you is you got to believe in this system in order for it to become a philosophy, not a presentation. And then years ago, I remember hearing this an Emerson quote that said that what's seen to be done for an effect is seen to be done for an effect. But what's seen to be done from the heart is seen to come from love. And you guys have to understand that that connection that you have and the belief that you have in the business and the concepts is what really drives your success in helping your clients engage into the right concepts that's going to change their financial future. So let's get started. What I'm going to go through is some breakdowns of what we teach our guys and what I've been taught through the years that changed my life, is developing the right financial habits. And if you look at our main challenge right now, the big crusade, you're going to see this on the screen, is at Wall Street versus Main Street. Well, some of the challenges that we're having is there's constant products being developed from Wall Street, and some of them are good and some of them are bad. And we don't know how to make sense out of that. And our crusade is to teach our clients, protect our clients with the right fundamentals and habits against some of these products that could damage them. So the true crusade is Wall Street against Main Street, and we're right in the middle of that. So what I'm going to cover right now is four major points in the training. Is number one, cover the problem. See, there's a lot of challenges that we have when it comes to our money, some bad habits and bad behaviors that we've developed that causes us or prevents us from building financial wealth. And second thing we're going to talk about is identifying those right and wrong habits. Third is developing an investment philosophy that you believe in. And fourth, very important, is show how to use some of the tools that we have available to get that concept and get that vision across. I was taught a long time ago that if you want to connect to people, I don't care if it's in the business or anywhere else, is that there's two people that you're going to be speaking to when you talk to a person. Inside their mind, there's an emotional side, and then there's a logical side. And I don't know if you've ever seen pictures or seen an example or been to the circus where you have an elephant and a rider, but the elephant basically runs the path. So if an elephant wants to go down a certain path, it's going to go down that path whether the rider likes it or not. And an elephant in this situation, this story, is their emotion. The rider is the logic. So once you have the emotion down and also back it up with the right logic, you have both elephant and rider going down the same path, the path that's going to make them get them the proper success. So it's important you guys understand that it's not just a technically driven presentation, not just a technically driven philosophy. It has to have some emotions. Our job is to protect our clients from the noise of the media out there and all the different influences that causes them to make the wrong decisions with their finances. Folks, you have to understand that right now we have a tremendous market. And because of the fear of what's been happening out there and the chaos, people have taken most of their money and gone to cash. Just if you look at the graphic here, there's $6 trillion sitting in money markets and CDs. And that's not even keeping up with inflation. You have cost of living rising, incomes going down, not enough return on their money to even keep up with cost of living and purchasing power. And so you're having a tremendous issue here. If you see $6 trillion, a lot of people don't realize that's just money market CDs. That's not counting other areas that they have cash in. And that amount of money, if you just want to understand the power of that, a $6 trillion, dollar standing up on top of each other, just stacking them up, is 627 feet. If you look at the Statue of Liberty, it's 240 feet. That's 2.5 times, or more than 2.5 times the height. That's how much money is sitting in cash, basically eroding away, not even keeping up with cost of living. So that tells me that more than ever, people have a lack of real knowledge and don't have an investment philosophy to get them across the finish line and become financially independent. So that's what we're going to really cover today and get into some details. So I want you guys to understand that there's a difference between having a presentation and having a philosophy. A philosophy is based on something that you believe in. A presentation is just going through the motions. You have to understand the problem that people have right now. The problem is, if we look at a $10,000 investment in those money markets and CDs, they're averaging in money markets 0.03%. That's enough to buy a cup of coffee at the end of the year. In one-year CDs, 0.13%. That's not even 2 tickets to the movies. That's if you go matinee, but if you go yourself, that's $13 in interest. That's not enough. And then bag of groceries, $196. That's about what 10-year treasuries pay. So we're not even getting the true value of what our money can do for us, not even keeping up with cost of living. And you see, the problem is not so much the return. The dilemma that we're facing is we're dealing with banks, CDs, treasuries. These instruments are not giving us the proper leverage that we need to get to our goals. The biggest dilemma that investors have out there is that they're buying homes, they're putting kids through college, they're planning for retirement, and these vehicles we just talked about are not going to get them there. So they need a better philosophy, they need a better system, a better education process, and that's where we come in. I was always taught that this business, I remember Nick Murray mentioning this, and I really caught on to it years ago when I started the business, is this is the only industry where you teach others to become wealthy and become wealthy in the same process. And if you have the right philosophy, they'll get wealthy. If you're just trading stocks or just selling mutual funds, you're not going to get them there. So you have to be serious about really doing this the right way. So let's get into this. Most important thing that we have to understand, what's preventing us from getting financially independent is not having the right financial habits. Well, importantly the same is having the wrong financial habits. And when you have bad behavior or bad habits, you'll never, I don't care what fund you put them in, you'll never get across the finish line. And so let's cover that real quick. First of all, bad habits. We got to eliminate the bad habits if we want to get into the right habits to get across finish line and become financially independent. Well, one thing that we do is we listen to the media. So the first bad habit we have to eliminate is don't listen to media hype. How many times has the media hyped us up over and over? They can never be sued for their recommendations, yet the clients are always left with the aftermath of that decision. We got to teach our clients how to shut that off and be totally focused on their plan. See, when they don't have a plan is when you start seeing people listening to the media, their friends, the lunchroom, the guy that's getting 20% on his 401k, and suddenly he read an article and he's an investment guru. If he's an investment guru, what's he doing there? We have to have a better plan than just hearing that kind of information. Second is don't follow the masses. Just because everybody else is doing it, it doesn't mean you should be doing it. Just like you saw the interest-only loans that imploded in the last few years. We're recovering from a 5-year bad financial hangover of bad financial habits. And because the masses, we got caught up in the masses, so don't follow the masses. Third is don't market time. Listen, there's no statistical evidence, none, that anybody can foresee the future. So if that's the case, you have to understand that you can't foresee the future, and neither can those people writing the articles. You guys pick out the mutual fund of the year. Look, the mutual fund of the year, you got to understand, they never repeat. It's like the American Beauty pageant. You never see a repeat. You have to understand that. And so if that's where your investment philosophy and that's how you're investing, you're going to get caught as soon as the correction or there's a trend change. Fourth thing is don't panic out. And we have to really teach them how to not panic out and stick to the plan. I've had clients just recently, because of this correction in the market and government shutting down, calling me and asking me, what do I do? Nothing. You stick to your plan. Has anything changed at work? Has anything changed in your finances? Stick to your plan. Our job is to make sure, see, before we're investment advisors or financial coaches, we are behavioral coaches. We got to teach them how to stick to their plan. So now that we have the 4 habits that we have to pay attention to and identify for them that are bad that we have to eliminate, now we got to replace them with the right habits. Look, it's just like when you go on a diet program. They say people that get on those programs, by the time they get off, they're worse than before they got on because they gained it back plus some, because they never replaced a bad habit with a good one. And in this situation, we're going to actually replace those bad habits with the right financial habits to get them across. That's where you have a higher success ratio. So let's talk about the wealth building habits. Let's talk about what really makes a big difference. Point number 1, faith in the future. You got to have faith in the future. I had a client call me the other day and says, the government shut down. I said, well, are you getting your passport ready to get out of the country? He goes, no. I said, well, what are you worried about? They're going to figure it out. They're going to move on. The day I was born, June 4th, 1968, the S&P 500 was around 100 points. Today, it's over 1,600. Does that tell you something? That means in the long run, you're going to see a growth upward pattern no matter what. So you have to have faith in the future, and we have to use tools that the companies brought out for us to show those concepts, the inflation, stamps, the S&P 500 last 50 years, to build up a case so they have something. They replace fear with proper knowledge so they start developing their faith in the future. I'm not going to cover a lot of those concepts. I'm going to hit the top of what you need to focus on, and then it's your job to do your homework and fill in the blanks and start learning and developing. At least now you have an outline of what you need to learn. Second thing is pay yourself first. There's no replacement of paying yourself first. You guys hear it all the time. The old lady that has millions of dollars in the bank making almost nothing. It wasn't the bank that got her wealthy, it was her habits that got her wealthy. And that's really what you have to understand, is we need to start teaching our clients how to pay themselves first. Third is become an owner, not a loaner of your money. See, I read this in a Financial Planners magazine years ago, that the true people that build wealth in this country are owners, not loaners. They own their own cars, they own their own homes, they own their own investments. They don't have middlemen using their investments. They own them, they make the return, they have an equity position, and they own their own career. And what does Primerica bring to the table? All of those. A chance to have a plan to own instead of loan. And that's really where the true wealth is. And then fourth is develop a cash cycle habit. See, it's important to know that you need to be an owner, but if you don't know what to do with it or how to do it, you see a lot of these financial programs out there people are signing up for, and they show what needs to be done, the final, but not how to do it. And what we're going to break down today is how to do it and what needs to be done to develop a cash cycle habit. Now, most importantly, you're going to see this slide, the emotions of the market. And when I saw this, I realized that when, in absence of a plan, markets make corrections, people lose money. And if you look at this slide, basically what it's telling you, you see this big S curve, and really people start out optimistic about the market, and that's what happened at the beginning of this year. Their optimism's high. They pick a few stock funds in their 401k. Their broker gives them a certain stock fund. And then what happens is there's an excitement because they start looking at their statements. They start building up confidence in what happens in the market and their decisions. And suddenly you'll notice there's a thrill. Wow, I'm smart. I picked the right funds and things are working fine. And just at the height of that, at the height of the market, where they call it euphoria, that's the maximum risk. People are the most confident about making right financial decisions, and then it starts going the other way. You're going to start seeing, a little correction, and then the anxiety sets in. And then you start saying, well, temporary setbacks are fine because I'm a long-term investor. But before, 4 or 5 months ago, you're a genius and you can never make a wrong decision. And then denial sets in, fear, market keeps going down, then desperation. And then you see panic set in, capitulation. And here's where people start making mistakes and start losing it, is when pessimism sets in because the market keeps coming down. How could I have gone so wrong? Well, they don't have a plan. They don't have a benchmark to compare to. They're just following the emotions of the market. So right where there's the maximum opportunity, which is the bottom of the market, when the values are the best, they cop out, they panic out, and they lose. And what happens is, right after that, you'll start seeing the value investors buying in, loading up, and then skepticism sets in, and then you see hope because the market's coming back up, relief, optimism, and back into the same nightmare all over again. That happened in the last 3 decades, from the junk bond crisis to the first real estate crisis, then the dot-coms, and then the last real estate, because people get caught up in the cycles and trends and don't have a plan. So what's the answer to that? We need to sit down and really realize that in the absence of a plan, people make bad mistakes. We need to have a program, a concept, a habit that they develop, that they stick to. So what I want to cover with you guys today is realizing the difference of having a plan and sticking to it versus emotionally getting worked up. And most people have a lot of stories. But if you look at the last 20 years, look at the S&P 500, the last 20 years, the S&P 500 had returned, with the correction, 8.2%. So if you just bought and held the last 20 years, you would have saw an 8.2% return a year. Now, the average investor into the S&P, into mutual funds, stock funds, only saw 4.3%. Do you guys see that on the screen? 4.3%. That means because they got in and out, in and out, in and out, no plan. They didn't stick to their plan. They emotionally got driven. They lost close to 50% because they didn't have a plan and stick to it. So that tells me that really people do not have plans, and that's what we bring to the table. You guys understand the financial needs analysis is not just a sales tool. It's a tool to give people a compass, a direction to their finances, and something they can stick to. So I want to cover that a little bit, is that we have to understand some of the things that we grow up with in the industry, is that, the fund of the year, the total returns of the funds. Look, our society is driven by performance. And performance-driven decisions, when there's corrections, people may panic, and also start getting into funds that they shouldn't be in. See, there's no statistical evidence, like I said earlier, that you can foresee the future. Well, you have to understand a couple of things that we have. I want you guys to write this down. The way you reach your financial goals is with a sound financial plan long term. And there's no substitute. Listen, people with plans make it financially. People that substitute plan with performance-driven ideas never make it. You have to understand that. And if we are going to get into teaching them the right fundamental habits, we have to make that clear that you have to develop an investment philosophy based on fundamentals, not performance. So next slide, you're going to notice that's what we're going to tear down. And I'm going to show you a tool, one of the tools that you can use that really helps you start developing the right conversation piece. See, first thing I want to tell you is, you want to make note of this, is do not sell on performance. Corrections happen. There is guaranteed, as the market is guaranteed to go up the next 50 years. Corrections will always happen. Do not get caught up in that, because then you start covering up one lie after another of you know the market. You don't know the market. You need to have the right habits and the right attitudes towards the market. You want to make sure that the foundation of your presentation is objective planning. Like I said, there's no substitute for that. And when you have a plan, you'll have a direction. So now that you get into the conversation, I'm going to get into the three fundamental account conversation. I was taught this years ago. I took a continuing education course in '91. It totally changed my life. It was outside of the business, and the old man that taught me taught the class, he had a bunch of people there, some brokers and so on, and they weren't really taking it serious. And I was young, and I was here to get a financial education, learn how to manage my own money. And I remember sitting down, and he said, listen, 95% of this country is in the debt cycle, 5% in the cash cycle, and the 5% run to 95%. Where do you want to be? And the second question he asks is, do you understand the difference between the two? And he says, the ones that have a cash cycle and control their finances, they have the right habits. The ones that don't are in a debt cycle, they get controlled by their finances. And when I heard that, it made total sense. It was common sense to me. And when he's talking about the three fundamental accounts, I totally believe that concept, because it worked. No matter what was going on with the market, it was philosophically right. It was fundamentally driven. So when you have that conversation, the first thing you have to understand is you have to connect with your client. There's two things that you need before you get into your presentation, before you do an F&A, before you do any investment advice. You need to connect to their goals. And that's called client needs. And that's the first thing that we teach our guys is before you even start any kind of recommendation or take any kind of information, is start, and you'll see this on the screen, list their top 5 financial goals. Now you might see this sheet and like it. We actually use a legal pad. I just did this for the presentation's sake and for training. But top 5 financial goals. Mr. and Mrs. Client, what is the top 5 financial goals that you want to see solved with your plan? I want to get out of debt. I want to put my kids through college. I want to retire. You always hear those. And you get specific with them. When do you want to retire? Get a little specific so they understand that you're trying to put a plan together that's right for them, that they want. Once you have that, the second thing you need is you need to get them involved in the presentation, but you need to get them involved with a monthly commitment to pay themselves first. If you don't, I tell my guys, if you don't have that commitment, nothing's going to happen. So let's break this down, and I'm going to show you this on the screen real quick. We sit down with a client. They know what their take-home pay is. They might not know their gross pay and everything else, but they sure know what their take-home pay is. So you want to start with that. So, Mr. Client, how much do you take home? $3,500. We write that down. Mrs. Client, how much do you take home? That's $2,500. So together, you guys take home $6,000 a month that comes into your checking account on your paychecks. Yes. So, well, here's the breakdown. If we're going to make this plan work, you have to have a financial commitment to yourself to pay yourself first. And remember what we talked about in the presentation is that now you want to start developing the cash cycle habit and get out of debt cycle. This is the first step, is paying yourself first. And look, I'm going to come up with some numbers. You're going to come up with what's comfortable for you. So we're going to take baby steps, so don't stress out. But if you look at this, majority of our clients put away about 10% of their income. And based on your take home, that's $600 a month. We have a fortunate few, about 15%, that's $900. Those are limited or fixed budget, about 5%, and that's $300. Which one of these would you feel most comfortable with paying yourself first? And you'll see all kinds of numbers. You know, you'll see the male ego kick in, and he can do 900. And then you look over at the wife, and that's not going to happen. Well, you need to bring down, and here's one thing that I've taught all my agents is apologize and say, Mr. and Mrs. Client, I'm going to probably ask you that question 5 times minimum to make sure that I have a real number so I can give you a real result. Once you have that number, you'll notice that a lot of people, majority of them, will pick 10%. And I've always taught my agents is if their average car payment is $300 or $400 and a car dealer can get that out of them, there's no reason you can't get them to put 10% towards their future. There's a rule of thumb that you can start with. So let's say it's $600 a month, and she's not okay with it. So how much are you comfortable with? She says, well, $500. Well, great. Let's start with $500, and then once you're on your plan for a few months and you feel comfortable you could do more, we can always increase it. But let's start baby steps. And you'll notice they automatically diffuse and they're comfortable, because now they're comfortable with what they're putting away. They understand the 5 goals, the top 5 goals that they're going to reach because it's theirs. Now you can get into using the 3 fundamental accounts. So now that you pull out the basics of investing brochure, now you have some meat you can actually use. So now that they have that commitment, you go through how the basics of investing works. I'm going to go through this for a few minutes right now and go through the presentation. But see, American families, Mr. and Mrs. Client, both live in different types. There's 2 types of stages that people in this country live when it comes to their finances. Majority of them live in a debt cycle. Their finances control them. Very few live in a cash cycle where they control their finances. And the only difference between these 2 that you see is the debt cycle, they have the wrong habits. The cash cycle people have the right habits. Our job is to get you over from the debt cycle to the cash cycle habit and develop the right habits where you control your money. And all the threats to your financial security, none is more dangerous than debt. So that's the reason why you can't max out your 401k. That's the reason why you can't max out a short-term account, a travel fund, a college fund. So we need to start developing those right habits. So that commitment that I got from you, now you know where this is going to fit into. Solution is very simple. We need to set up a pay yourself first cash cycle with the dollar amount that you gave me. And at the same time, we need to set up a debt stacking program. So cash cycle, you have your 3 fundamental accounts. And now here's very important. At this point, this is a very important note that you need to make. At this point, you hand them a pen and get them involved, because this brochure you're going to leave with them. And you want their handwriting and their notes on it. So that if they call you and they're second guessing something, you tell them, pick up the brochure, go to page 4, or go to page 5. And you'll see how this works. But see, when they're involved though, this is the most important thing. When they're involved in the presentation, they internalize it. When you're just presenting to them, you're just showing them. So at this point, I give them the pen. I said, we're going to use this in just a minute in a couple of exercises, but let's start with the 3 fundamental accounts. Number 1 is emergency account. You want up to 3 months income built up there, so that's your goal to build it up. And you're going to use it for anything within the next 0 to 2 years, like an emergency, vacations. So if you plan to work on the yard in 6 months, that money goes in this account. So remember the timelines and know what your target goal is to build it up. Next is a short-term account. Short-term accounts, usually up to 6 months is what your goal is to build it up. And it's for any withdrawals within 3 to 5 years. Something you can use for loss of job or a disability, unforeseen events. But also what you're going to be using for larger purchase items, like buying a car, down payment on a house. You can get more value when you get a house where you can put 20% down. Well, this is the account that you want to build at 3 to 5 years so you can do it the right way. And the most important part of the short-term account, once you fund that and develop that habit in the next few years, you're in front of the 8 ball and you make the decisions. You get the best value for your money. And then the third is your wealth building account, which is any kind of retirement account that's available to you. And there's all different types and different types of investments, but they all fit into one of these 3 categories. So now that you understand that, how do we develop the habit of getting into it? Well, here's the worksheet. Let's get into it. So he has the pen or she has the pen in her hand. So now we had $500 put away. $100 that was going to cover your insurance. You didn't have any. We agreed, and that's a different conversation, to protect your income. So we have $400 left. Now that $400, I want you to write it in, the total amount right here. So you write it in, $400. Now, rule of thumb is you want to start off conservative. So we want 50% going to emergency. You write that in. 25% going into short-term, and 25% wealth building. So you have $200 going in emergency, $100 going in short-term every month, and you have $100 going into wealth building. And what we're going to use for the emergency fund is a money market. You can see that right down there. The second is a conservative allocation like a balanced fund or something that's conservative, 3 to 5 years. And then your wealth building, I'm going to teach you two concepts and two tools that you're going to use to get the best value for your money. And the first concept is understanding what you're building it for. It's for your retirement. So you see on the page, it says retirement age. You write in the retirement age. What, Mr. or Mrs. Client, what age did you say you wanted to retire? 60. You write it right above the target. You guys will see this on the screen. Right above the target, you're going to write in 60. So your goal is to get the money to grow until that point in your wealth building account. So when you're in your growth years, so you use growth type funds during this period, and then when you're retired, your focus is income years, and then you use income funds or switch over to income type funds in your later years because now you need income. You don't put income funds in growth and growth in income. So that's very important that you understand the separation of that and making sure your investments are in the right category based on your goals and objectives. The second tool that we're going to teach you is dollar cost averaging. This is probably the most magical tool on developing value long term. If you look at these two examples, because the market always goes up and down, it's guaranteed to do that. But if you look at the long haul, 40, 50 years, it always grows because it has to. Economies grow, inflation grows. But the challenge that we have, where we lose the most money, is the short term when it's up and down. We don't have a plan or a tool to walk us through it, and that's what this tool is going to help you with. Now, if we look at the two different type of scenarios you have investor one buying into a rising market. Everybody loves a rising market. But the challenge is that's not really true long term. We always have corrections. But in this scenario, we're just going to leave it in the rising market. So you start at $10 a share, and I want you to follow at the bottom here. As you start investing that $100 a month, the shares go up in value, and you're buying less and less shares. But at the end of that period of time, you have 42 shares. The next scenario is a fluctuating market where most people run away from or make bad decisions in. And if you start off $100 a share, and I want you to get your pen out on, and it's very important that you understand this concept, is that $100 a share, when it starts going down in the fourth month, it goes from $10 to $2 a share. At this point, I want you to write right next to the 4, negative 80%. It went down negative 80%. What do most people do at this point? And they'll say, freak out, panic, sell out. You're going to hear all kinds of things. So, Mr. and Mrs. Client, I want you to write this down underneath the negative 80%. They panic. But because you're going to stick to your plan, you're going to stay focused. And it goes from 2 back to 10 2 months later. It started at 10, it ended at 10. And you're thinking, I didn't make any money. Well, you just do the math. You take the first scenario, 20 times the 42 shares, figure it out, what the value is. And the same for exercise B. You'll notice you have 126 shares because when it got cheaper, you were loading up on more shares for your dollar, and then when it got more expensive, you ended up with less. And that's the concept. That's where you're going to get the most value. Now, if you stick to this, if you see that, you got more value in the B than the A. Why? Because you stuck to your plan. Now that you understand this, going into the market, your emotions will be intact because you understand how the market works. You replaced fear with knowledge. And now that you understand how that works, you go to the next slide, you'll see that the investment profile questionnaire, we pull that out. So now for your wealth building, and these are for your wealth building, I want you to go through these questions now that what you've just learned and see what type of investor you are so we can match your investment objective with the proper investment. They go through the questions at the end of that time, and then you go to the next page, and whatever they score on there, they put it right on there. It could be a moderate growth or a growth, and now you can put a portfolio together for them, whether it's an asset allocation or an Ibbotson model, whatever fund. You know, a lot of people ask me, what kind of fund do you use? I said, any fund. It's the fund that you believe in. That's secondary to having a plan. Have a plan, and then making sure that when they're talking about their wealth building, that it fits their asset allocation model, and that's what you go with. So hopefully that helped you guys out. We just wanted to give you some fundamentals, but teach you guys some concepts to build your confidence. In closing, I want you to understand a couple of things. This is just the beginning. This is just touching the surface. If you're going to build it here and be successful, you got to master your craft. You got to use this as the sounding board that you're going to start building off of, and start reading the How Money Works. Start reading serious, well, it's not Serious Money anymore, it's Simple Wealth, Inevitable Wealth by Nick Murray. Some of the concept books that are going to help you reinforce these concepts, and at least this gives you a start to get it moving.